Hi, everyone. First of all, happy Friday from the offices here in Reno. A beautiful day here, as I see it is in San Diego as well. Hopefully everyone has a fun weekend planned. But before we start the weekend, let's discuss Social Security and what I like to call advanced Social Security. And by that, I simply mean we do the basics in the first presentation. I'll review the basics very quickly. I'm going to speak very quick because you can go back and review it on YouTube. But I'll hit what I call a couple of the highlights. And then I'm going to move into actual claiming strategies and things that you should think about, not just in the context of Social Security and how to maximize your and your spouse's or your partner's Social Security, but also how to think of Social Security in the broader context of your retirement plan and what it means from a standpoint of retirement planning. All right. A couple key things that I want you to take away from this advanced Social Security presentation. Number one, Social Security is the most guaranteed pension that the world has ever seen, okay? I'll go over some of the numbers about the security of it, and this and that and the other, but it is a lot more guaranteed than the UCSD pension. And what do I mean by that? You got 33 million taxpayers in the state of California backstopping UCRP or the UC retirement plan. You have 330 million taxpayers backstopping Social Security. Realize that when we pay Social Security taxes in our paycheck, as those of us that continue to work, that money doesn't go into a coffin or into a treasure chest or something. It immediately gets paid right back out to beneficiaries of Social Security. So it's not a Ponzi scheme. It's actual real money from people that are working, right, going to people that are retired that have earned their benefit over their lifetime of working, okay? A little background on Social Security, 1935 Social Security Act. Full retirement age used to be 65, then it stepped up to 66, and now for most people everyone born after 1960, it's 67 is full retirement age, and then there's a stair step between 1954 and 1960 I will go over. But the biggest concept for today, one, Social Security is the safest pension in the world. Two, Social Security has a huge tax advantage to it at the federal level and in California. We'll talk about that. Three, I want you to remember that Social Security is not just about your own benefit, it is about your surviving spouse's benefit. And in fact, when I consult folks on Social Security, it's probably the single most important thing that I have them consider is it's not about your lifetime or your life expectancy, it's about the dual life expectancy of you and your spouse, especially if you were the higher income earner throughout your life. So without further ado, let me bring up the presentation. And again, I will go through some of the basics here. Again, just for a quick refresh, but I also, everybody see that presentation okay? Somebody give me a thumbs up, just make sure you guys are seeing the same thing I am. Go to presentation mode. Everybody see my picture there with Savvy Social Security Planning? Is everybody seeing that? Vanya, can you give me a thumbs up? Okay, great, thanks, Chris. All right, so again, if you want a more comprehensive review of the basics of Social Security, I encourage you to go look at the YouTube video because I'm going to fly through the beginning so that we can really get to those, what I call advanced or claiming strategies that I think you should consider as you are approaching Social Security. I want you to look at the bottom here because this is really important. Your friends aren't experts, but it's possible your CPA, your attorney, maybe even your financial advisor are not experts in Social Security as well. When you go through the certified financial planner courses, which takes, roughly 3 years to go through and then the test and all that stuff. And when you go through the chartered financial analyst, all these, there's not a separate thing on Social Security and Medicare, right? You really have to become your own expert. I don't mean you, I mean, if you are someone that lectures on this material, you really need to become an expert through other sources. Unfortunately, I think we should, especially as financial planners, it should be a significant larger portion of our training, and I'll tell you why. So 1/3 of Americans that are in retirement or consider themselves retired, their only source of income in retirement is Social Security. And the average retiree in this country, almost or over 1/3 of their income in retirement that they're receiving in retirement, right? The average retiree in this country comes from Social Security. So in my opinion, if your CPA or your financial planner does not understand Social Security, then you need to see a Social Security expert. If they don't have a tool like we have to do an analysis for you, then you can always come to me. We're free, have been ever since Shazan Chaffee got me to start doing these presentations back in 2009. It's part of my deal with Vanya and previously with Suzanne, is that if you are a retirement or a Emeriti Association member and you're part of the Retirement Resource Center, then you get a free Social Security analysis from myself and our team. So that's a benefit of joining the RRC. So with that being said, just remember, your friends aren't experts. It's not a Ponzi scheme, right? And your choices impact both spouses, all right? So these are the things we're going to go over today. And again, a lot of these slides I'm flying through right now are available in the first YouTube. One quick thing to note, even as recent as 2020, when we had the pandemic, and I've kept this slide up because I think it's important, that was the last time we went through recession, you could see the total income to the Social Security Administration was greater than the expenditures to retirees. Mind you, in 2020, baby boomers had already started entering retirement. And the big fear was Social Security. And why you get all this fear mongering about it's a Ponzi scheme, it's going to run out of money, yada, 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 is because this large demographic, which are the baby boomers, are now moving into retirement. The good news is we also have this really large demographic, which has now surpassed the baby boomers, known as the millennials. And they are, well, most of them, we're not going to talk about how hard they're working, but most of them are now fully employed, okay? And so the millennials are the baby boomers' source of Social Security, which is a good thing, right? Most of them are out there working, and I'm sure they're hard workers. That was a joke, probably a bad one with that. I'm a lot funnier in person than I am on Zoom, apparently. So again, it's not a Ponzi scheme, right? It is. Here's the problem. The costs are expected to far outweigh the income in the near future. And if there's not any foreseeable or any significant changes made to the way we do Social Security right now, whether that's full retirement age or how much we subject income to Social Security, then potentially by 2034, benefits would fall to 79, roughly 80%, and to 74% by 2092. I didn't say they would go away. I said they would fall by roughly 20%. Okay, so that's still an issue because a lot of people depend on Social Security, as I said at the beginning. And a lot of you are dependent on, and you've earned, quite frankly, you've earned your Social Security benefit. It's yours. You've paid into the system. You should not have your benefits cut. And so that's the challenge that Congress faces, is trying to figure out a way that's fair to everyone on how to deal with the shortfall in Social Security. One of the number one ways, quite frankly, and we could talk about, I don't get into politics in any of my presentations, but one of the number one ways you can solve this problem is through immigration, okay? Legal immigration. What I mean by legal immigration is people that are actually paying taxes in this country and working, because that raises the amount of people that are putting into the system that's being paid out for the retirees. All right, so that's one way that's not mentioned here. You can reduce benefits, reduce cost of living adjustments. I don't think a lot of those are tenable. If you are a politician and you want to get fired as a representative or a senator, I think it's pretty easy to do. You could just say that you're going to lower Social Security benefits for that demographic that tends to vote the most of all the demographics. And so I don't think that's tenable either. The top one is probably the most likely. Continue to significantly increase the maximum earnings to subject to Social Security. And then below that, raising the full retirement age. That's already happened twice, and I wouldn't be surprised to see that again in the future, particularly maybe for Gen X, my generation, but more particularly like the millennial generation. I would not be surprised to see the full retirement age raised to something like 68 or 70. So anyways, as a baby boomer, your benefits are most likely not going to be affected by Social Security change. All right. So one of the biggest concepts in Social Security to remember, and again, I'm going to fly through some of the parts that I already covered, is that it is inflation protected income, right? The COLA is determined every October by the CPIW. In fact, it should be coming out here soon. And then that gets added on to your January check the next year. I want to be clear, because a lot of people confuse this. If you are not claiming your Social Security benefits today, if you're 62 and you say, I'm going to wait on my Social Security, I want to wait because I listened to your lecture, Ryan, you still get the benefit of that cost of living adjustment, right? Chris, thank you for that. Did they just come out and announce that? I hadn't seen the trustees report, or I saw it came out, but I didn't read it. Thank you, Chris. Chris Wright is on top of it, 3.2%. And that comes after last year's COLA, which I believe was 8.7 or 8.9. It was huge. And so these cost of living adjustments are really important of in what makes Social Security such a valuable benefit to you in retirement. If we are in a high inflationary environment like we've been, your Social Security benefit's going to keep up with inflation much better than your UCSD pension because of the way the COLAs are done with the UCSD pension. And if you have questions about that, I do a lecture in 2 weeks on the 403B and 457, and I'm sure Vanya can talk about that at the end if needed, or you can just go on the website for that. All right, so Social Security is income you cannot outlive, and more importantly, your spouse can't outlive it either. So how much can you expect to receive in Social Security? It's simple. It's just, your working career and then the age at which you apply for benefits, right? So it's your highest 35 years of earning, okay? So if you haven't worked in a job for 35 years, then they input zeros for your number. So if you worked 32 years, you'd have 3 zeros. That's one really easy way to raise your Social Security benefit, is to make sure that you work for 35 years. Knowing how to do the benefit formula is not important at all. I have that for the first lecture just so there's an idea. The bottom line is you can go to ssa.gov and get your benefit. They will tell you what your estimated benefit is today, but that's very important to understand. That's not what your benefit's going to be when you retire if it's not the same day that you check your benefit. And that's because of the cost of living adjustment and the fact that Social Security, the Social Security Administration, does not do estimations of COLAs. And that's really important to understand, because your benefit, and this is the good news I have for you today, your benefit is most likely going to be significantly larger than you think it's going to be, and I'll explain why here shortly. All right, so once you apply for benefits, I say the majority of the time you want to delay as much as you can, but sometimes people come to me and they have a health issue, or they just have health problems traditionally in their family, and so they want to take their benefit early, and I understand that. More importantly, if you don't have the income or the income you need in retirement, or you have some sort of health event, then you're going to need to start your Social Security benefit. But other than that, I think it's really, really important to consider survivor needs, whether or not you plan to work, and your need for income. Will it be enough to live on in retirement? I would assume most of you are here because it's not your only retirement asset, so I'm going to say probably not. Here's that full retirement age I talked about. Okay, full retirement age, your primary insurance amount is the amount you're entitled to from Social Security at your full retirement age. Okay, so if you were born before 1954, 66, stair steps up, as you can see, 2 months for each year after 1954 until 1960. Anyone 1960 and later is 67. Why is full retirement age important? Because it's the age at which you can earn as much income as you want, W-2 and 1099 income, and not be subject to the earnings test. The earnings test simply is a test that Social Security performs if you are prior to full retirement age. There is something called the earnings test. Now, this is not income that you derive from a pension or IRA distributions, capital gain distributions, dividend distributions. That's all passive income, all right? It has to be earned income, which is W-2 and 1099. I had somebody that emailed me last week, and they were very confused about that versus what's called the provisional income formula that's used in Medicare for what's called the IRMA. Okay, the provisional income formula takes in all kinds of income and adds some other stuff in. The earnings test does not do that. It's just earned income. Earnings test, earned income. All right, so what if you apply early for benefits? Let's just use 66 is your full retirement age. If you apply at 62, you're going to lose 25% of the benefit. If you wait to 66, you get 100% of that PIA, primary insurance amount. Here's the good part. If you wait a little bit longer, you get an 8% kick after 60. If your full retirement age is 66, you get an 8% kick each year, and you get the same at 67. If your full retirement age is 67, you get that 8% as well. But you don't just get 8%. You get 8% plus the cost of living adjustment. And as Chris Wright just told us, it's 3.2% for this year, right? That's going to be added to January's paychecks. So that would be, if you decided not to take your Social Security early and let's say you're 67 and you're going to be 68, you would have just got an 11.2% increase in your Social Security benefit with no risk whatsoever. Zero risk, right? And so one of the things I tell folks is that if you can wait to beyond your full retirement age, you get an 8% increase each year, plus a cost of living adjustment that's averaged between 2.5% and 3% each year since 1983. That's an 11% rate of return. Who would not take I'd have a line out my door and around the corner if I could guarantee people 11% rate of returns. And here's the kicker. You don't pay any taxes on those gains whatsoever, right? Because they're just being added to your Social Security benefit, okay? So the amount you can add to your Social Security benefit, if your full retirement age is 66, is a minimum of 32%, all right, on top of your primary insurance amount. But if the COLAs are high as they've been over the last couple of years, you're looking at adding another 40 or 50% total, not plus the 32, but 50 to 60% to your Social Security benefit. So if you're looking at your statement and it says your benefits say $3,000, right, when you're 66, you don't even know it, but your benefit could be well into the $4,500 to $5,000 range by the time you actually get there, which is huge, right? Because that is also potentially a survivor benefit for your surviving spouse. So I'll discuss here in a bit. So anyways, if you want to get your benefit statement, you go to ssa.gov. You don't have to type in socialsecurity.gov. You can just do ssa.gov and you can pull your statement. Here's one of the things I want to be clear on the statements because it's very important. This is a very, very important concept. You see the column on the left here that shows ages, 62, and in this case, this person's, we're assuming we're assuming a primary insurance amount of $2,800 and 2.6% annual COLAs, okay? If we look over here, right, the only time that this benefit is actually right would be on their 62nd birthday. And you could see that by the two columns on the right, the benefit with COLA and benefit without the COLA are the same number. They're both 1960. Each and every year after that, what the benefit without the COLA is, that's what your Social Security statement would say. Okay, so if you get a statement at 62, it's going to say 1960 for 62, it's going to say 2,800 for 67, and it's going to say 3472 at 70. And the majority of people that come into me and they say, I've done the cost benefit analysis, they omit the most important part, which is the cost of living adjustment. And if you look to the very right column and you compare, at 62, the numbers are the same because that's the age of this person on this chart. But look at the difference of the numbers, assuming a 2.6% cost of living adjustment. The difference is almost $1,000 a month in the benefit between what it really is and what the paper is going to show you that SSA is going to give you. Okay. Now imagine if instead of 2.6, inflation over the last 3-4 years had averaged closer to 4 or 5%. Right. So now you can imagine that number at 70 is going to be significantly higher than 4263, probably somewhere in the 4,800 to 5,000 range, which is a significant difference from what they're showing you on paper. Again, this is the power of compounding interest in the form of the cost of living adjustments. And it's why I am a big advocate for delaying Social Security benefits. So someone out there may say, well, Ryan, like you said, 1/3 of income comes from Social Security. So where am I supposed to get the income from? Well, there's a couple answers, right? One is certainly to continue working. That's usually the answer no one wants to hear. What's the other answer, right? Well, if you've saved any money over your lifetime, you probably have a 403B or a 457 or some form of investments that can substitute for Social Security. I'm going to come back to that concept at the very end of this presentation because it's probably the single most important concept of this entire presentation. All right, moving along. I was just checking the chat there. It's easier for me because I have boxes of all of you on the right side of my screen. I've got the chat on the left side. I'm trying to keep my slides going here too. So if you do have a question, please unmute yourself and feel free to just interrupt me because this presentation is for you. It's not for me. I'm nowhere near Social Security. I still have probably about 30 more years to go before I get there, or 25, I should say. So if you have a question, please feel free to stop me. All right, so how can we maximize benefit? Well, you can review your statement, see if there's any years in there where the IRS did not report to Social Security. And then most importantly, apply at the optimum time, okay? Let's talk about taxes real quick because I think this is a really important concept. So first of all, this is the earnings test, right? If you apply for Social Security before full retirement age, they reduce the benefit. You can go read about the benefit adjustment in the first presentation. don't let the annual earnings test discourage you from continuing to work. If you want to avoid the earnings test, it's real easy. You have to wait to full retirement age to begin your benefit. All right. The taxation of benefits was never indexed for inflation back when they first published these in, I believe, 1982 or 1983. They used the provisional income formula. This is different again than what the earnings test uses. This is a very inclusive form of determining income. The bottom line is taxation of benefits. Most of you will be in that married filing jointly over the 44,000, so up to 85% of your benefit will be taxed. But think about that, 85% of your benefit, not an 85% rate. So 15 cents on every dollar at the federal level is taxed at zero. So that makes a Social Security dollar at the federal level worth a lot more than your pension distribution, an IRA distribution, a 403B, or 457 distribution. But here's the kicker of Social Security. It's not taxed at all in the state of California. It's zero. The state of California has made the decision, the first time I've ever heard them make a decision that it didn't involve taxes or less taxes. It's one of the states that does not tax Social Security, which is a fantastic benefit for all of you that are in California, is that you will not pay any state income tax on your Social Security benefit. So it's tax advantaged at the federal level, and at the state level, it's zero. So it is worth significantly, a dollar of your Social Security benefit is worth significantly more than a dollar out of your pension, a dollar out of your IRA, and a dollar out of your 403B, 457. Okay? Okay, so way to minimize taxes, Social Security benefits. I'm not really going to go through that because, you know, converting traditional to Roth is not really optimal in California because of the highly progressive tax rates. The second one here, anticipating your IRA RMDs and consider drawing down IRAs before 72. That's exactly the strategy that I'm a proponent of. There is a white paper that was published right before the Great Recession called Rethinking Social Security in a 401k World. It was done by the Pension Research Council at the Wharton School of Business out at UPenn. And it is a great paper, 50 pages of reading on why you should consider drawing down your IRA, your qualified accounts, what I mean by that, your retirement accounts, prior to 72 and delaying Social Security to 70. By the way, don't ever delay Social Security one day past 70 because there's no benefit whatsoever. All right. Remember that your Part B premiums do come out of your Social Security checks. All right, so key points to remember: if you apply early, your benefit stays lower. COLAs magnify that impact. Don't let the earnings test discourage you from working, and delaying benefits may give the surviving spouse more benefits. All right, so let's go through some of the specific insights and strategies on claiming. All right, so for couples, and this is the first rule of thumb that I'm going to give you, and it's very important. For couples, you should always maximize the higher earner's benefit to protect the surviving spouse. The survivor benefit, if the surviving spouse is full retirement age or later, the surviving spouse gets 100% of the higher benefit. They don't get their benefit and the higher benefit. They get 100% of the surviving benefit. There are all these different strategies, and it gets really creative if you are a widow, because you can claim a survivor benefit at age 60 versus a spousal benefit, which can be claimed at age 62. If you are a widow, it gets very, very complicated because you can go from a survivor benefit to a spousal to your own. It gets very complex, and I always tell people, if you're a widow or a survivor, or you've lost a spouse, or you lost a spouse, or you've divorced somebody who has passed away, later in life, whatever, you're eligible for their survivor benefit. If you were married for 10 years or longer, and that goes for the same for divorce benefits as well. So what is the spousal benefit? Well, it's 1/2 the primary worker's primary insurance amount if started at full retirement age or later. So here's the example. John's PI is 2,000, Jane's is 800. If Jane applies at her full retirement age, her benefit would not be her own benefit of 800, rather it would be half of John, right? So between the two of them, they'd be getting $3,000 a month in benefits. So what are the rules for spousal? The primary worker, so John must have filed. There's no more file and suspend. That was taken away in 2016. And the spouse must be at least 62 for reduced benefits, right? Or full retirement age for full benefits. There are no delayed retirement credits on spousals. So if you are a spouse and you have a fairly low benefit and your spouse has a fairly high benefit and they are older than you, once you reach 66, there is no need whatsoever to delay claiming the spousal benefit. Coordinating the spousal benefits. So here's maximization strategy. And this is another rule of thumb. And again, I'm going to leave the slide up here for a little bit so you can always go back and review it on the YouTube channel, or you can take a picture if you prefer, whatever you want to do. But the strategy for a maximization strategy is where the lower earning spouse's primary insurance amount is more than 50% or higher. Both spouses would delay to age 70. Okay. Now, there's been times when I've done analysis and it's not that much of a difference, so we decide not to do that. But one spouse takes advantage of spousal benefits as allowed, and this maximizes lifetime benefits over an average or a long life expectancy. On the contrary, here's the hybrid strategy, where lower earning spouses' primary insurance amounts is less than 50% of the higher earning spouse's PIA. Then the lower earning spouse claims early, and the higher earning spouse claims at 70, going by our rule of thumb that if you are the higher earning spouse, as much as possible, you wait to age 70 because you're also protecting your spouse through the survivor benefit. This hybrid strategy generates income sooner while maximizing higher earning spouse benefits over both lifetimes. Getting a custom analysis, I've got a sample that I'll go through here in a second, so I'll kind of skip over that right now. Widows, divorce benefits, you may be eligible for survivor benefits, divorce survivor benefits, or divorce spouse benefits that can increase your monthly check, right? Survivor benefit is extremely complicated. I'm not going to go through it too much. Just if you are a widow, we usually have maybe one or two per presentation. Contact me directly. In fact, I'm going to put my email down here in the chat right now. So you will have that. Because survivor benefits are very complex and require a lot of thoughtful thinking and a proper analysis. A couple examples there I'll skip because, like I said, let's just go over the rules. The couples must have been married for at least 9 months at the date of death, unless you get married and then there's a tragic accident or something like that. The survivor must be at least 60 for reduced benefit or full retirement age for full benefit. Right? Survivor benefit is not available if the widower remarries before age 60 unless that marriage ends, and then you can go back and claim that. And the divorce spouse benefit, survivor benefit, available if the marriage lasted at least 10 years. There's the old story of Johnny Carson, who I believe had 3 or 4 different wives, all married for 10 years or longer. And so each one of his spouses, or I should say ex-spouses, were all claiming on his Social Security benefit. And of course, it doesn't affect well, I know he's since passed, but it didn't affect his benefit whatsoever. My mother and father were married for 12 years. My father's been remarried now for 27 years, and both my stepmom and my mother are both claiming Social Security benefits off of my father, right? And my father did wait until he was age 70. So, quite frankly, my father was a fairly high income earner most of his life as a captain for American Airlines, and he and my stepmother, their combined Social Security benefits on a monthly basis are well over $5,500 a month. So Social Security can be a significant source of income in retirement, especially for couples that both had pretty good income during their working years. All right. A divorce spouse benefit is just the same as a spousal as long as the marriage lasted 10 years. The person receiving the divorce spouse benefit is currently not married, cannot be married and take someone else's benefit, right, or an ex-spouse's benefit. The ex-spouse has to be at least age 62, and the divorce was more than 2 years ago. Ex-spouse does not need to have filed for benefits. So it's just a couple rules around divorce spouse benefits. Let's skip some of those because I really want to get into the analysis and how it works. So Social Security brain teaser, if life would rather be early or delayed, pay a penalty or get a bonus, right? Well, people are hurting their retirements by making terribly costly decisions about Social Security. Final insights here before I go into an analysis and what it looks like, right, is remember that Social Security offers inflation-protected income you can't outlive, including benefits for survivors, right? Survivor benefit, 100%. Guaranteed, full faith and credit in the United States government. Tax advantaged, no risk. Your monthly benefit will be reduced if you claim early. Couples should always maximize the higher earner's benefit for the surviving spouse. And if you're widowed or divorced, remember you may be eligible for benefits that increase your check. All right, so let's jump out of the slides here. And let's go and let's take a look at the lighting in this conference room is terrible, by the way. I'll get that fixed soon. I'm actually moving into a new office soon, Vanya. All right, so I have a sample analysis here, that I want to share with you guys. All right, can everybody see this? Can somebody just give me a thumbs up if you could see? Okay, perfect. All right, so this is just an analysis, sample analysis, make-believe couple. And what I want to show you here is how these analysis, how they compute. These are all the disclaimers, right? But here are the different scenarios. Minimize that a little bit. All right. So what happens here is, you know, these are fake people, but if they weren't. So Keith's 61. This scenario, sample scenario is done on May 1st, 2022. We did a COLA of 2.5. In our program, we can make the cost of living adjustment 4%, 3%. We can look at all the different scenarios. We have a spouse that's older than the husband. The husband is the higher income earner, right? You could see that by PIA. Keith's at 3129, Veronica's at 1,000. So we know his income history or his earnings history is higher than Veronica's, right? We did a standard life expectancy, 85 for Keith and Veronica for 90. So what is our number one for a maximization strategy? What is our number one rule of thumb, right? The number one rule of thumb is that Keith, even though he's the younger spouse, right, he is protecting Veronica by waiting to age 70, right? So we can go right here and see a maximum lifetime nominal benefit has Keith, as we just said, waiting to age 70. And look what his benefit is. His primary insurance amount, right, is $31.29, and he's 61 years old. When we calculate a simple 2.5% COLA, his benefit at 70 comes out to just under $5,000 a month. So again, he's not only protecting that income for himself, but he's protecting it for his spouse over their lifetime. Would any of you believe that a couple that simply has a $31.29 and a $1,020 primary insurance amount, if they live to be 85 and 90 with a maximization strategy, it'd be worth $2 million in Social Security benefits? Okay, that is a large amount of Social Security benefits. Would everyone agree? I hope so. Okay, that is significant. And look at the difference if they both claim early because they're hurrying up to claim. 1.5 million if they live to 85 and 90, and 2 million. That is a $500,000 mistake, right? In terms of 2 million, it's a 25% mistake, but in terms of 1.5 million, that's a 33% mistake because you just went and grabbed that benefit early. What I'm trying to share with you or impart on you in this lecture is don't be short-sighted because you're right there. You're right in your early 60s. And that's why I specifically put this couple at 61 and 62. Veronica could literally start her benefit today. Does that make any sense whatsoever? No, because it would shorten their benefits over their lifetime by potentially $500,000. And why is this important? And really quickly, I'll just stop the share on this one, and I'll go to what our questionnaires look like so you have an idea. And actually, I didn't bring up a questionnaire. No, I did. Give me 1 second here if I can find it. Maybe it's here. No, I take it back. I did not bring up another question, which is fine. The questionnaires are just pretty simple and straightforward. They do have a place that say primary insurance amount. If you do decide to do a questionnaire and send it in to us, I can also send you a link that will be secure, so you can share all the information that's required on it. I'm going to go to the whiteboard here real quick because I want to finish today's lecture with a very important concept. Everybody see the whiteboard here? All right. I want you to think of your overall retirement in the form of several buckets, okay? And I apologize ahead of time. I am not an artist. My oldest daughter is an artist. We have her in art classes and custom art lessons. I don't know where the heck she got that talent from because my lovely wife can't draw either, and my oldest daughter is like a savant when it comes to drawing. And it's pretty incredible to watch, especially with somebody that has zero artistic talent. So one day, Vanya, I'll share some of the paintings that she's done with you guys so you can share them. They're really cool. And she does them all freehand off the top of her head. She's a big chalk drawer on the driveway. It's really, really cool to watch. All right, so let's think real quick about your overall retirement, okay? So just because he's my top right box, I'm going to say this is John, okay? Hi, John. John Thomas there. All right, so this is John. And let's say, and this is not really John's situation, I'm just using him as a name there. So sorry, John, you're an unwilling volunteer. So we got Social Security over here. We've got the big P. We've got our pension from UCSD. I'm going to put IRA here, but I want you to assume this is a 403B, 457, if you have a spouse that's in a private employer, or 401k, whatever you want to call it. All right, what are some other sources of income? Because these are the three we've really talked about, right? Let's just say you have a trust or an investment account of some kind, right? And then I know everybody in San Diego loves their real estate. So let's just say you have a rental property, okay? So all of this comes down, right? And eventually gives us what I like to call our, again, I should have my daughter here to help me draw this. This is our mailbox money, right? Okay, so that's my version of a mailbox there. So this is our mailbox money. Now, let's talk real quick about these different sources of income and their different taxations. This is your pension from UCSD. Who is this guaranteed again by? By the 33, oh, it's an ugly three, by the 33 million, right, residents of the state of California. How is it taxed at the federal level? Right, it's ordinary income. And then at the state level, I'm just gonna do rabbit ears, it's the same, ordinary income. So every dollar that comes out of that pension is taxed ordinary income. What about the IRA? Ordinary income and ordinary income. What about the trust? Well, you're in California, so at the state level, there is no capital gains or dividend rate, ordinary income. And I'll just put a question mark up here because it could be short-term capital gain, which is ordinary income. It could be a long-term capital gain, which has some benefits at the federal level. Could be a dividend, which has some benefits. And real estate's the same. You get some depreciation, all that good stuff. But California still charges ordinary income. Well, what about that Social Security dollar? Well, if you recall, Social Security is only taxed at 85 cents on the dollar. It's supposed to be a period. So 85 cents on the dollar at the federal level, and it's a big fat donut at the state level. So the tax efficiency of a dollar of Social Security is greater than every single one of the sources of income. All right. I'm going to erase all this. What does the generally investing in the markets look like? Well, if you're all in equities, it's like this, right? You know, it's all over the place. And if you have a diversified portfolio, then maybe it's a little bit less, and you have something like this, right? And then if you have bonds, then it's supposed to be much more steady, and then 2022, and then, whatever, right? So as we get older and we get into our latter years of our life, and I'm going to maximize my screen and my view of all of you here in case I get some questions. But as we get later into our life and we get later into our investments, we're in our 70s and 80s. What kind of investments do we want? Do we want something like all of this, or do we want something that's steady as she goes and getting a paycheck one after another, after another, after another? The premise of rethinking Social Security in a 401k world is that as we go later and later in our life, we become more and more conservative and more adverse to market swings because we're no longer making money. We are dependent on our income. So if you take the strategy that I just did in the buckets and that I advocate for, and you exchange a dollar of your 403B 457 by using that in your 60s to draw down in your 60s out of that versus drawing down out of Social Security, you are effectively exchanging a dollar of your investments for a dollar of your Social Security. This has two other benefits you may or may not be thinking of. One, do you know any investment advisor, any investment house, any brokerage house that does everything for free? The simple answer is no. Even if you do all your stuff in Fidelity, you have a financial advisor like me, you work with Merrill Lynch, you work with Schwab, doing it yourself, even Robinhood. There are investment fees and costs to every transaction that's done, from a taxation standpoint, from a standpoint of execution, from a standpoint of who's doing the execution, maybe advice, all these other things, all right? What investment fees and expenses do you pay to Social Security to write you a check every month? 0, okay? The other thing, and I think the most important concept, is when you're trading a dollar out of your investments for a future dollar of Social Security, you are significantly reducing the future risk of your retirement because you're switching a variable dollar that's going to be invested in market, bond, money market, cash, whatever, and you are putting it in the hands of the federal government that has 330 million taxpayers backstopping that pension. And with that, I will finish and I will open up to any questions or concerns or anything you have. Emotional outbursts are okay too. I encourage you to just unmute yourself. I also have the chat up. Mike Ono says, what information do you need from a divorced spouse to make an informed decision on Social Security claiming strategy? Mike, that is a great question. I know a lot of people maybe don't have the best relationships with their ex-spouses, and that's fine, because guess what? Social Security won't tell you where they are. They won't tell you what they make now, but they will tell you what their primary insurance amount is. And you probably already know their birthday. So if you can get those two pieces of information, primary insurance amount and their birthday, you're good to go. And you get that information to me, and I send you a couples questionnaire. And I know, I don't know if you're referring to yourself or someone else, but that I understand they're not a couple anymore, but think of divorced spouse the same as a couple, just because that's how we look at it, as long as the marriage lasted 10 years or longer. Great question, by the way, Mike. Thank you for that one. Mary, I'm not gonna try to say, I'll just say Mary P. Can I claim spousal benefits and delay my own until full retirement age? No, you used to be able to file a restricted application. It actually depends on your age, Mary. I think you have to be 60 or 69, but since you're not at full retirement age, you can no longer do this. If you sign up for your benefit now, assuming that your spouse is claiming their benefit already, or ex-spouse, however it is, you will get the higher of your own benefit or 50% of your spouse's benefit reduced for the actuarial reduction because you're not at full retirement age. If that all sounded like a bunch of gibberish to you, I understand it's very complex. I'm happy to do analysis for you or write you an individual email. Just please see my email above and feel free to write me, and I will respond to you as quickly as I can. Thank you, John. You're always too kind to me. That's why I used you as my sample. Do any more questions out there? Feel free to unmute yourself if you have one. If you don't,
hi, Ryan. Ryan, it's Tom and Julie.
Yes, please.
Quick question.
Okay. Yeah.
You talk about the spousal benefit being half the primary. I'm older than my wife. I've claimed at 70, but does she get half of my PIA plus the COLAs plus the 8%, or only half the PIA plus the COLAs?
The latter. You do not get delayed retirement credits on spousal benefit. I don't know what your wife's full retirement age, but most likely 66 or some form of that up to 67. She's going to want to claim, if she wants 50%, it won't be 50% of your benefit because you claimed at 70, which good job for that. You've given her a great survivor benefit, I'm assuming, if something were God forbid to happen to you. But she, at her full retirement age, she should apply for benefits because there's no reason to wait beyond that, right? Now, the one caveat to that is if remember, there's the hybrid strategy and the maximization strategy. If she has a very large benefit of her own, she may want to consider waiting till 70 because she will get the delayed retirement credits on her own. She is not eligible any longer to file a restricted application. That ended, I think, 2.5, 3 years ago.
Yeah. Well,
the people
hers is actually much lower than mine. So to that extent, I think.
Is it more than 50%?
Yeah.
Is it more than 50% lower?
Yes.
Than what yours was at your full retirement age?
My PIA, I think my PIA was something like on the order of 2,800 or 3,000 maybe. And hers is going to be closer to 600, something like that. So it's definitely less than half of my PIA. So she should claim at full retirement age. And that
absolutely, that would be that's the maximization strategy for you, right? That's right. Yes.
So in terms of if I am going to keep working,
if you claim it won't hurt you.
I can collect.
It won't hurt you because Once you're full retirement age, remember, you're not subject to earnings test. You can be Warren Buffett and make $500 million a year, and it doesn't matter.
You still get it.
So I can collect and keep working?
Correct.
That's right.
Great. Thank you, Ryan.
Weird. Okay.
Absolutely. There are some things you may want to email me separately that you want to think about if you're continuing to work and you have your benefits and all that. That's going to have to do with Medicare. It's called the IRMA, the Income Related Monthly Adjustment. If you want to email me on the side, I'd be happy to just tell you what, and I'll send you the chart for that you want to consider when you have two benefits, Social Security benefits. It sounds like you're over 70, and so you got RMDs coming up either at 72 or if you already started them. So there's something you want to consider with the IRMA and Medicare, because it can really push you up into another bracket within your Medicare Part B and D. But that we can take that offline just because I'm running out of time here.
That's okay. Great. Thank you very much.
Thank you. Yep. And by the way, I don't normally wear colorful shirts like this for presentations. I just happen to have a golf match that starts in 15 minutes. And this is my golf shirt for today. So, John Thomas, if I get married before I start drawing Social Security, can my future wife continue to draw them if I die first? If I get married before I start drawing Social Security, okay, can my future wife continue to draw? Yeah, that's so going back to the survivor rules, John. You just have to be married 9 months, and she'll be eligible for all of your benefits, unless, God forbid, something tragically happened. The reason they have that 9 months is to prevent people from, marrying somebody, on their deathbed or whatever, or the bringing the bride over from another country, and then that's the whole reason for that.
Okay.
Again, my email is up there in the chat. You're free to review this presentation. If you want a free analysis, you certainly don't have to have one. It's free. Again, I'm happy to send you a questionnaire. Just shoot me an email, and I'll shoot you and let me know if you need the couples or the single questionnaire. And I thank you, everyone, again for a wonderful fall. And I'll be back in, let's see, a week and a half, I believe it is, for the 403B 457 discussion. And yeah, thank you, Mary. And have a wonderful Friday. And let's see if I can actually hit the ball straight today. Have a good one, everyone. Take care.
Oh, it went away.
Thank you so much, Ryan.
Take it.
Thank you, Vanya. Bye now.
It took away.
You don't need that?
It took away the chat.
You don't need that?
No, took away the chat. It took away the chat.
It's just bad.
Yeah.
Oh, is she still on?
Yeah. It is.
I'm leaving the chat open in case you need his email.
Oh, can I ask you a question?
Yeah, of course.
There's that movie tomorrow about the Iranian filmmaker.